I'm here with Edmund Leung of the elite-rated First State Global Listed Infrastructure Fund. Great to have you here today. So whilst infrastructure has seen a surge in popularity over the last few years, we've had lots of new fund launches. You at First State have obviously been doing it for now over 10 years. So what are your thoughts for the asset class going forward?
Yeah, so our fund recently celebrated its 10-year anniversary here, and we think it's delivered our clients pleasing performance over that time. And this has really been driven by the nature of the underlying companies that we own. So the characteristics that we look for would be high barriers to entry, strong pricing power, sustainable growth, and predictable cash flow. This leads us towards the companies that own or operate toll roads, railroads, ports, airports, energy pipelines, mobile towers, satellites, and of course, utilities. What we have found is that over the past 10 years, both the breadth and the depth of the asset class has grown as governments have looked to privatise their assets and also as corporates spin out these assets.
And obviously last year we had the election of Donald Trump. He came with lots of promises of huge infrastructure spending. And have you seen any of that actually come to fruition, or has that helped in any way, or has that broadened opportunities for the asset class? Or has actually it been a bit of a disappointment so far?
The US has some great assets. So if we look at the freight rail sector, energy pipelines, mobile towers, and some world-class utilities, there's some great assets there. Usually, in terms of regulation, it's either state-based or it's a business-to-business transaction. So from a federal fiscal policy point of view, it's still very early days. So we haven't seen much of an impact yet. But some areas of opportunity for 2018 would be in the freight rail sector. So these companies are full cash taxpayers. So if there is any change in the corporate tax rate down, then they'll benefit in the form of higher earnings. Moving over to the mobile tower sector, the federal government is actually in the process of rolling out a brand new first responder wireless network. And this will see more radios and antennas on those towers, which means higher rents. And
we've seen central banks now start to raise interest rates around the world. In the US, we've just had the first interest rate rise in the UK for 10 years. Infrastructure historically is quite sensitive to changes in interest rates. So can the asset class still perform in a rising interest rate environment?
Yeah, James, that's a great question. And would break apart the potential rise in bond yields to two different factors. So one, could it be through higher inflation, or two, could it be through higher real rates? If it's through higher inflation, then that's a great thing for our asset class. Most of the assets that we invest in are able to pass through inflation, either directly, that's written into their contract, or indirectly as they true it up over a 6, 12, 18-month period. So if you think about a toll road that we own in Australia called Transurban, next quarter's price is based on last quarter's CPI reading. Switching over, if a rise in interest rates is due to a sharp increase in real bond yields, then we think the asset class might struggle a bit versus general equities. What our fund can do is that we can tilt towards the more growth names, away from the defensive, lower growth bond proxy names, to help mitigate that risk.
Great, and thank you very much for joining us.
Thanks for having me.